Welcome back. My name is Matthew Coyle. This is You Heard It From a CFP. That is Des Moines, Iowa behind me. I'm in town for the day visiting a few clients, and I thought this would be the perfect place to do the intro video to this week's topic on You Heard It From a CFP, which is insurance. And nobody does insurance like Des Moines, Iowa. How to calculate it, what to look for, how much do you actually need, and how do you avoid buying too much? Let's dive in. Okay, well these days it seems like you cannot throw a stone in any direction without hitting someone that wants to sell you life insurance. So we are specifically talking about life insurance today. Now when you're writing insurance policies, generally speaking, it's pretty straightforward. You find an asset that you want to insure, whether it's a car, a home, whatever. You find an agent that you're comfortable with, you pick from a few policies with a few basic features, and you write the policy. Now, generally speaking, that's pretty simple. When it comes to life insurance, it's a little more complicated and a little trickier. So, how much do you need? How can you avoid buying too much? And what are the two generally accepted ways of calculating how much you need? They are the needs-based approach and the human life value, or essentially what we call the HLV approach. We'll look at both real quick because they can result in very different numbers and very different costs. Let's take a look. All right, so we will start with the needs-based approach first. Now, the needs-based approach is less complicated than the HLV approach because there's no real discounting involved as far as future income. But I'm going to have to assume a couple things in order to do this. Now, what I'm going to assume, as I consult my notes here, I'm going to assume that a theoretical person is 40 years old, has an average income of about $65,000, has a $200,000 mortgage, and has about $10,000 of estimated end-of-life expenses. Now that could be burial expenses, it could be cleaning up old credit cards, it could be whatever that person wants to clean up as far as expenses at the end of their life or what the family wants to identify as that. So we're also going to assume that the family wants to cover at least 10 years worth of income, that they cover all those family final expenses, and they want to cover any debts, which in this case is just the mortgage. We're going to keep it simple. It's a very simple example. Now, under the needs-based, the total of this would be $860,000 of life insurance. Now, how do you get there? Well, you get there with $650,000 of income. That's 10 years worth. You have debts of $200,000, so we're going to cover that. And we're going to cover final expenses of $10,000. So that's what the needs approach would get us. It's a very simple way of getting there. All the debts, plus some income, plus some final expenses, and you basically got your coverage. So you would approach the agent, you'd write the policy, and that would be that. Most people would cover this with term insurance in most cases because it's a cheaper way to go, and most people who are using this way, this particular way, the needs-based approach, are going the cheaper route. So $860,000 in this case would be roughly the amount of insurance you wanted. You could raise or lower it based on the income replacement that you wanted, but in this case that would be. Now, how would that contrast with the human life or HLV approach? The HLV approach is a little different. There's some discounting involved and a little bit more math, but let's look at that and contrast and see what the difference is. So basically, in summary, the needs approach is just covering what you need to cover in your final expenses and any debts plus income. So that's why they call it the needs approach, but let's contrast that with the HLV approach and see how the two would differ for this theoretical person. All right, so how does this differ from the HLV approach, the human life value approach? And the human life value approach, in order to calculate it, we have to do some discounting and some math to figure out the total number we need. And the number we need is always going to be higher than the needs-based approach because it's more comprehensive. So I'm going to go back to my notes here. I'll tell you exactly what we're going to assume. We're going to assume that the family is going to cover the economic loss of value until retirement. And that's the difference between the needs-based approach and the human life value approach. The HLV approach assumes total economic value of someone producing income until that income theoretically stops. So of course, the younger you are, the more insurance you would need, and the older you are, the less insurance you would need on this approach. But in this case, we're going to assume total economic income replacement until retirement age, which we're going to assume is 65. All the other factors stay the same on mortgage and income and age and all of that all stays the same. So under the HLV approach, the total is $971,576, or just rounding up $972,000. Now, how did I get there? Well, I got there as follows. So I assume $65,000. Now we have to figure after-tax income. If this person was in the 25% blended tax bracket, what they would do is they would discount by 25% the one-year income. So that would be $48,750 of after-tax income. Now what we do from that is we take that number and we discount it back at 4%, which is what I picked as a conservative investment return, until retirement, which is 25 years. You discount that back to the present value and you'll get $761,576. You add debts onto that of $200,000 and final expenses of $10,000, and we get $971,576. Now, the two methods are very, very different in that one includes economic discounting and one does not. So the needs approach is strictly needs and income replacement. The economic life value, the human life value, is a discounting process of after-tax income forecasted out to a certain point. So they're a little bit different. And sometimes a financial planner is helpful to walk you through what may or may not be the best value for you. It's more expensive to cover the HLV method because it involves more coverage. One way to avoid buying too much coverage is to avoid these blended investment insurance products, which I'm not a big fan of. But let's talk about some other considerations when it comes to choosing which method might be right for you. So, wrapping it all up, which method should you choose, the needs-based approach or the HLV approach? Well, if you take the HLV approach, you're probably going to result in more coverage. It almost always results in more coverage. So it's going to be a little more expensive route to take, and that's going to require a little bit more insurance coverage, which of course depends on your budget. If you're purely concerned with covering things like debts, just a few years of income, or maybe specific assets that you have to cover with life insurance, then go ahead and use the needs-based approach. So really budget and whatever you cover as far as the asset base and income is going to determine which method you pick, whether it's the needs-based approach or HLV. Now personally, I take the HLV approach because I want to take into more of an income component of what I want to cover for my family, but not everyone's the same, and the older you are, the less expensive it is to cover your income because you don't have as much of it in front of you. And the younger you are, the more expensive it is to cover your income component. So for young families, for example, I will always tell them to try and work the HLV approach if they can afford it. For an older family that's maybe more concerned with just covering certain mortgages or debts or specific assets so that everybody knows they're covered, then I would say maybe just keep it temporary and go the needs-based approach. But it's really going to depend on your budget and what you want covered. So that's what I would recommend for now. What I would avoid is buying anything with an investment and an insurance component to it, like a variable annuity or variable coverages of any kind. Stick with either term insurance or whole life insurance in its traditional form. If you can do that, that's my favorite form. I have a mix of term and whole life myself. I recommend it to most every single one of my clients. If you have any questions on it, please reach out and I can certainly elaborate on that. But thanks again for watching, and we'll catch you again next week, and have a very good week. Thanks.